People typically say a recession is once the gross domestic product rate is negative for 2 consecutive quarters or additional. However, a recession will quietly begin before the quarterly gross domestic product reports area unit out. That is why the National Bureau of Economic Analysis measures the opposite 4 factors. 1. That information comes out monthly. 2. Once these economic indicators decline, therefore can gross domestic product. Additionally, the National Bureau of Economic Analysis (NBER) defines a recession as an important decline in economic activity unfold across the economy, lasting over a couple of NBER is that the non-public non-profit that says once recessions begin and stop. It's the national supply for measure the stages of the trade cycle. The NBER uses the talent, judgment, and experience of its commissioners to see whether or not the country is in a very recession. 3. That approach, it's not boxed in by numbers. It will use monthly information to see once a peak has occurred and once the economy has simply began to decline. 4. That permits it to be additional precise and timely in its measurements. Commissioner Shiskin instructed this quantitative definition as a result of many of us weren't certain if the country was in a very recession in 1974. That is, as a result of it absolutely was affected by inflation. Though gross domestic product was negative, costs hadn't fallen. Inflation was caused by President Richard Nixon's economic policies that chiefly took the us off of the gold customary. That, together with wage price controls, created double-digit inflation. 6. A clearer image of those economic events over time is also seen by gauging the nation's gross domestic product by year.